Hey, how's it going, everybody? This is Micah Lamar. Thank you so much for joining Mark, Sebastian, and I today. Really excited. Mark and I met about a year and a half ago, and since then we've been kind of keeping in touch with each other. We also got to hang out in Chicago when I was invited to speak at the CBOE. Mark was there speaking as well, kind of helped put the event on, and we talked about getting him in front of our community to kind of teach everybody a little bit about some of his experiences being a floor trader in the pit in Chicago. He was also a market maker, which gives him a really unique perspective into how options are traded, a little bit different than the perspective that us as retail traders have. And for those reasons, I think it's a good idea for everybody to kind of take notes and kind of ask questions, get engaged. I know Mark has a very interactive webinar, likes asking questions, kind of being engaged with his people. So feel free to kind of pick his brain. This is a good opportunity for you to get inside the brain of somebody who is a market maker and actually traded on the floor at the SIBO. So with that being said, Mark, are you there?
Yeah, I'm there. Thanks for having me, Micah.
No problem.
Yeah, folks, I'll tell you, you're right. I met Micah about a year and a half ago in Las Vegas at an event, and I go, wait a minute, you're smart and young and not washed up. What are you doing here? Why are you running a trading company? And we hit it off really well from that point on. Just him and his lovely wife are just tops on my list, and that's why I'm excited to continue to work with him, and I see us having, doing lots of fun stuff together. So if you see Mark and Micah on the agenda, that is going to be something that you're going to want to be at because it's, I like the fact that Micah brings it as much as I like to try to. So today we're going to talk about trading weekly options. I'm going to cover a lot of ground here. This is not a short webinar. Um, so this is me. I was a floor trader for about a decade. I traded in New York on the American Stock Exchange, then in Chicago on the CBOE. After I left the floor, I started Option Pit. We're an education consulting firm. We'll work with professional groups, helping them with option implementation. So I'll work with our registered investment advisors or funds that are getting into trading stocks and help them implement trades. And then with retail people, what I really try to do is try and help them understand the professional, kind of a professional approach to risk management and trading options, kind of the way we would. So I used to say that when I left the floor, I was a little dyslexic because I was so used to order flow coming to me. Now in my business, it took me a little while, but we really figured out how to generate flow, and that's what we do. Is we take a professional approach. So today we're going to talk about time value. We're going to talk about how the pricing model will break. This is one of the things that you have to understand is that the pricing model stopped working. We're going to talk about the advantages of using weekly options, some of the disadvantages of using weekly options, some strategic use of weekly options, basic use of weeklies in directional trading, and I'll walk through some trades we might do regularly here at OptionBit. All right. Decay. Options are just another form of insurance. As time passes, insurance policies lose value. All right, but even on the last week, insurance policies will still have some theoretical value to them. Right? So much like an insurance policy, options decay with the passage of time. And up to the last minute, an at-the-money option will have a lot of insurance value. I mean, if you think about it, when at 2:59 Central Time, 3:59 Eastern, a stock's trading $100, and there is 30 cents of time value left in the call and the put, that is an incredible amount of insurance premium. So this is how options decay. This is how most people think about options decaying. But this isn't how all options decay. This is how at the money options decay. And this is the key term, at the money. A lot of people look at this, go, oh yeah, Options do lose money exponentially as time passes. At the money options do. Not all options do. All right. So one of the interesting things is that there is this exponential at the money decay. All right. This is one of the real values in weekly options. You can short the exponential part of the curve. That means selling options as they're exponentially losing value. In theory, one should be able to harness lots of premium selling weekly options on a regular basis, especially in at-the-money options. However, it's not that simple when put to practice. Decay just isn't that easy, all right? Decay doesn't really work that way, all right? This chart is at-the-money options, all right? The further out of time we go, the further away from at the money, the more time decay becomes linear. So if, whereas at the money has this exponential decay, if I go 5–10% out of the money with a week to go, that decay is quite linear. It loses the same amount or even a lessening amount per day. Right? So this is an at the money option, and this blue line represents out of the money options, how they decay. And that convergence is really important. But the convergence is really caused by the fact that at the money options just die and out of the money options don't. They just slowly lose consistently. All right. So now let's talk a little more on decay. All right. If you were given the chance to flip a coin once, if it lands on heads, you get $1 million. And if it lands on tails, you owe $700,000. Who would take that trade? You only get to do it once. You put up $700,000, you flip a coin, and if it lands on heads, you get $1 million. And if it lands on tails, you lose the $700,000 you put up. Who would take that? Who's going to do that? Michael Jordan would, but he's worth $1 billion. How many of you would? Let's say you had a net worth of 10 million even. Would you do that? All right. No. Plain and simple, no. Even though it has a positive expectancy, the risk of losing is such a huge sum of money that it isn't worth the upside. So here's the second question. What if you got to execute that coin flip about 50 times before sides paid out? Then would you do it? Yes. Absolutely. All right. And so this is where what we would call teeny options come into play with weekly options. And here's the part, the first, couple slides, decay. Most people understand that decay is exponential at the money. Your average, above average trader gets that fact that, as you go out, things get a little more linear. But what a lot of people don't get is the decay and teeny options. And those are options that are really, really, really cheap. All right. Both at the money and out of the money options can decay to the point where they start to act like our coin flip game, where if you flip, 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 you win. All right. Now, then we get to these ultra cheap options worth less than a nickel. All right. While a nickel option may seem like it has edge to it, all right, or holding onto an option might seem like it has edge to it, because of the risk associated with being short teenies And the margin, most market makers do not sell them and work to close them. All right? And this is going to really affect how you should approach trading inexpensive options within the weeklies. And this is really important to risk management. All right? Now, one, there's this risk if I'm a market maker that I sell that, you go and close these options for a nickel, and then the stock drops or rallies and I lose a ton of money because I'm short cheap options. That's the first way to get fired. The second issue is that there's a haircut, which is kind of my market maker margin, that a minimum number applied to all options. And so inexpensive options are heavy in that minimum fee contract margin. And so they stop becoming worth it. So now, this is really what the decay looks like over the life of an option. It will decay. It will decay, then it'll really speed up at one point. And then when it gets to be somewhere less than 10 cents, that decay slows down again to a crawl all the way to like the day before expiration, and then it'll go.
Hey, Mark.
Yeah.
Do you mind if I say a couple things at certain points here?
Sure.
Hey, everybody. I think this is really important because, a lot of people who sell options and they want to squeeze every last penny out and let them expire worthless. I think it's important to kind of maybe reevaluate that thinking because you're holding so much additional risk by, hanging on to those options when they're only worth a nickel. Some brokers don't even charge you commissions when you buy back short options. And again, one of the thinking that I like to kind of highlight here from Mark is that if you sold it for 30 or 40 or 50 cents and it's only trading for a nickel, you've captured most of the credit already. Is it really worth holding on to all the additional risk just for that last little couple pennies? Generally, it's not.
Yeah. And, I'm actually about to show you guys why this approach is actually costing you money. And not just from a margin and risk perspective. All right, so let's think about how this is all interrelated. All right. So the last week of an option's life has a huge amount of decay when it's at the money. Out of the money options decay linearly. All right, the week and the last week very similarly. All right, thus there's not much edge in selling out of the money options, and the last nickel doesn't decay for a very long time. So now here's what I want you to look at. All right, now obviously this is an older graph, but I think it'll make what I think is a really good point. All right, so these this is General Motors, and this is the 36 calls are kind of at the money. All right, now the April 10 calls, the April 10 36 calls have 2 days to expire and are worth 30 cents. The May 1s, which are 22 days later, are worth 95 cents. All right, so there is a huge amount of edge in relative terms being short these options relative to being short this option. Right? Do we all understand? Would I rather get, from just a risk-reward perspective, would I rather try and collect 29 cents in 2 days or 95 cents in 22 days? Pretty clear, right, that there's a lot of juice left on these April 10s. But now, let's look at out of the money. Here are the 37 calls. All right, and we're going the next week out. So now we're looking at this April 17s, and we're looking at the May 1s again. And what I want you to notice, the April 37 calls are 14 cents with 9 days to expire. The May 1s have 51 cents with 22 days to expire. Which one actually collects more premium? Would I rather sell the 37s at 51 or the regular Aprils at 14? What's the better sale? Well, let's do some math here. All right, how many times does 9 go into 22? 2.4. What's 2.44 times 14? 34 cents. So if I sold the 37 call every week, I sold it in April, the April regular, and then I sold the April 24s with 9 days, rolled it, and then I sold the May 1s with 9 days. I would collect 34 cents. Or I can just sell the May regular 37 calls at 51 cents. What's the better trade? Right. When you start to go out of the money, it actually makes less sense to sell weeklies. And a lot of people think, oh, so the big bubble I want to burst is that selling any weekly option is going to be better than selling a further out option. Simply not the case. Right? I can pull up any stock right now and we'll see something similar. So when you're doing these spreads, when you're setting up spreads in weeklies, you got to think about where you're placing things. Now let's look at out of the money options. All right, now here are the April 10s again. And we've got the GM. I want you to look at the GM 37 calls and the GM 35 puts. There were 3 cents. All right. They have with 2 days to go, they're still worth 3 cents. And they're way out of the money. It is shocking the way that works. All right, I can pull up something right now. Come on. And you can see it pretty clearly. All right, so here's Apple. A lot of Apple traders here, right? Well, take a look. Let's just look at next week, August 100 puts. The August 100 puts that expire next week are 4 cents at 5 cents. So they've got 8 days to expire. And they allegedly lose 1.22 cents a day. All right? So if these are worth 4 cents and they're losing 1.25 cents a day, when should they be worthless? The answer is Friday. But I move 1 week forward And the par calls have a bid. They're 1 cent at 2 cents. Why is that? The answer is those options have diminishing decay. They stop losing money. And so that's where there's some real value in some of these trades. So the lesson, all right, weeklies are for near the money options. That is where the edge is. If you are selling out of the money options, you are giving away money and should move back either into further weeks out or back into the monthlies. And these little teenies take forever to run out of money. And so if you like to be short options, you're actually likely to make more money closing that penny option and rolling back than waiting for it to go out worthless. You know, the broker wants their commission. Who cares? So let's take a look at the par calls here, or the par puts, starting with September. So the September pars are worth 34 cents. And I'm going off on a little tangent here. And they lose 165 a day. All right. The Sep 9s are worth 24 cents. And they're losing 1.56 cents a day. So they're losing, let me double check. They're losing, there's a diminishing amount of theta developing. Now at a certain point where your notice says, why would I sit on this for so long? Now, so from the 16th regular Sep to Sep 9, I lost 11 cents. These are worth, the Sep 9s are worth 24. Now the Sep 2 pars are worth 16. So they lost 8 cents. The 26 par, the August 26s, these are 2 weeks away. They're worth 8 cents. So they lost about 8 cents. Now the next week out, the pars are worth 4 cents. All right, so intuitively, at a minimum, where does the diminishing returns really hit this position? Where do those out of the money options really start to not be worth it? Call it about 2 weeks. That cheap put starts to stop being worth it at about 2 weeks. And here's where you cost yourself money. So if I have a short position on the August par puts, and they're worth 4 cents, and I carry it all the way out to expiration, that's 2 extra weeks. I wait 2 weeks to make 4 cents. Now let's say that I paid the nickel on August 19 and then reopened the position on the by selling the 100s at 35 cents. So I collect 30 cents on that spread. 31 cents. By the time this August rolls off, The SEP 16s are basically the SEP 2s. So I could have, while I'm waiting to make my 4 cents, I'm giving up 16 cents. I want someone to lay out a scenario where the brokerage commission is so high that 16 cents isn't worth it. And if you can show me that scenario, you need to find a different broker. Because you are getting screwed. Any questions on that concept?
Hey, Mark. Mikey here again. Can you hear me okay?
Yeah, you sound great.
Okay, cool. So just to recap this to make sure I got it right, if I'm going to sell options less than 2 weeks, it makes more sense for me to sell them closer to at the money. But if I want to sell out of the money options, if my strategy is to sell farther out of the money, then I should be selling at least 2 weeks to 4 weeks or 5 weeks out, but never sell an out of the money option closer than 2 weeks.
Yeah, well, let's never say never, but for the most part, yes, that's going to be the case.
Gotcha. And then
You're
when
going
you say
out of the money to the point where you're dealing with, 10, 15 delta options that are outside of kind of a 1 standard deviation range, I will say, yes, don't sell inside of 2 weeks. Go outside of 2 weeks.
And then when you say par, do you mean at the money options?
Par is 100.
100? Okay.
So the SEP pars is the SEP 100s.
Gotcha.
So I apologize. That's trader. That's floor talk.
That's cool. It's cool.
I apologize. But yeah, so what I meant was the SEP 100s. So meanwhile, it's the exact, you're right, it's the exact opposite on if I looked at September, these are 109 is going to be at the money. So if I look at like the September 110s, there were $2 with, let's call it 5 weeks to go. With 1 week to go, they're worth like 70 cents. So clearly, there's a lot more decay to capture in the 110 calls in this case. So yeah, when you're setting these things up, think about where you're putting your trade. If you're going out of the money, go further out and then close when that decay really starts to slow down. You know how the decay went from like 16, about 12 cents to 10 cents to 8 cents to 8 cents to 4 cents. So at that point where we know decay just kind of screeches to a halt, it slams the brakes, that's the time to close. And if you aren't, you are costing yourself copious amounts of money. All right? So now, should one always sell weekly options when one is trading near the money? What about covered calls and cash secured puts? There is a trade-off. So the answer is yes, but there's a trade-off. All right. In return for the extra premium, you are taking on more price movement exposure, gamma. All right. So thus, if all goes right for me, so if I am long Apple and I'm selling covered calls, and I sell the August 110s and the August 26 110s, and I get to do that over and over again, and I collect 70 cents over that 5-week period, I'm gonna make $3.50. That's way better than the $2 I collect selling the September 110 calls. However, what if the underlying starts to move around? What if Apple starts to run on me? All right, I can get myself into trouble. All right, so the monthly has more raw premium. All right, so I collect $2 at once. All right, rather than 70 cents multiple times. Thus, if there's a pop in the underlying on like a covered call, I collected $2. I'll be okay. I'm good up to 112. The weekly option just expires and may take one stock away if it's not bought back. or worse, you cover. So Apple pops to 111 when I sell my calls at 70 cents. I buy my calls back for $1.25, and then Apple immediately falls. That can be frustrating. So weekly trading is definitely for more seasoned traders that understand how being short an option exposes one to price exposure and movement exposure. And these weeklies exacerbate the need to close worthless options. All right? There's an old saying, and I did this in Chicago too. I from Glengarry Glen Ross, I think at least once a week I go, A, B, C. Always be closing. Always be closing. And that is the way you should look at your trades. All right? Get what you're looking to make and get out. I know Micah teaches that type of risk management as well. It's one of the, again, why we're so simpatico. All right, now let's talk spreads. Generally speaking, there is edge in selling just out of the monies in the weeklies and hedging them with further out of the monies. So by that I mean the Apple weekly 110s when it's trading 109. All right, because of that hyper decay of the near the money options and the linear decay of out of the money options, credit spreads can make a lot of money very quickly. All right. So I'm not a big proponent. If Apple's trading 108.80, I'm not a proponent of selling the 109s, but I like selling the 110s. All right. And today is Tuesday. The 110s on Friday or Thursday are a great sale. So take a look at kind of what I can get out of these two spreads. And we'll look at some ones here in Apple in a second. So here's IBM. I can sell the August that have, till Friday, and I can collect 54 cents on those, on that credit spread. And this is from this week. This is from last night. 56 cents. Or I can go 3 weeks out and get $1. There is a lot more edge in my IBM weekly spread. If I pull up Apple and we want to compare spreads, let's look at the 110, 113. All right, so I'm buying the 113s because they're at that point where decay is really starting to slow down. All right, and we'll look at this across multiple months. I want to show you this. And then we'll just go to regular September. Now, we'll go to the September 9s, because they've got single strikes. All right, so let's look at these spreads. The 110, 113, and this is now a 3-day spread, is worth 23 cents. That's not bad. And you see, I'm selling an option that has some teeth to it. Not terrible. Now, my August 19s, and these are going to have 9 days to expire, are worth 55. That's also great. My September is going to have 1 month, so we've got 3 days Wednesday, Thursday, Friday. We've got 8 days. Wednesday, Thursday, Friday, and then next week. And we've got a month. And this picks in 93 cents. So the point is, I'm getting really good bang for my buck selling the, I mean, if you want to throw down the gauntlet, the ones that expire this Friday, that 110, 113, I would probably tighten this up. You can probably get away with doing the 12s. Get 20 cents out of that. That's not bad for 3 days of risk. Now, I want something that produces a lot of decay that maybe has a little less teeth, a little less price exposure. I can do the 110, 113 next week, sell it at 55, and then actually I could cover today, this time next Tuesday, for 20, call it 20 cents, 23 cents, and be in really good shape. That is way better, I think, than selling the monthly at 93 cents. There's no value there. All right. So the real edge in weekly options is the strategic placement of the trade. If you can pinpoint where one wants to take long and short risk, you can do really well. And it can help me pinpoint event risk. All right. Now, any questions on that decay portion I just walked through? I know it's a little complex. All right, so I like using these to get information. So Alibaba, they have earnings this week. All right, and I can determine so the question is, you suggest to sell a 9-day at-the-money credit spread. Well, here's what I would say is, if one is in the business of selling near-the-money credit spreads and you're currently doing monthlies, I think there's more edge. There's more potential to make money selling closer in credit spreads than monthlies. Right? So I don't like to say that I suggest selling 9-day at-the-money credit spreads, but if someone sells at-the-money or near-the-money credit spreads, and they're currently doing at the monthly, every month, there's more value in doing it the weeklies. How do you know what move the market is expecting? And I'm going to explain that. So here's Alibaba, and Alibaba's trading $85. And the market is expecting a $3.78 move in BABA, or about 4.5%. How? By looking at the money straddle price. All right, Alibaba, they have earnings on the 12th. Here, we'll look at it live right now. That's from yesterday. Let's look at it from today. All right, so Alibaba has them on Thursday before the market opens. And if I look at this trade, and I put it in a 3D risk chart, all right, this is called a straddle. And what a straddle represents is a option position that is, I like to call it 2 a.m. at the bar. What does the bouncer say at 2 a.m. when the bar is closing? Maybe not all of you are functioning alcoholics like myself. Last call, that's the bartender. What does the bouncer say? You don't have to go home. Get the hell out. That's funny. You don't have to go home, but you don't have to go home, but you can't stay here. And that's really what a straddle represents. It represents where if I don't have a directional opinion, but I have a movement opinion. So if I buy an at-the-money straddle for $4, all right, that basically means the market, the 50-50 bet, a little bit less than that, the about 58-42 bet is that Alibaba is going to move $4 or less. All right, so if I buy a straddle for $4, theoretically, about 58% of the time, that straddle should do break even or lose a little bit of money. That's the market's best guess at how much things are going to move. So if I'm trading Alibaba and I'm trading the straddle, if I was a market maker, you think I'm going to just sell you both directions at whatever price? No. It's kind of what we're looking for. And so a straddle, the combination of the call and the put, represents how much the market thinks Alibaba might move. And that graph that I just showed you is kind of what that position looks like. All right, I can also see strategic placement. All right, Tesla has a product announcement in May. All right, I can also see, just by looking at the IVs, when the market thinks earnings will be. So based on this, based on the set of implied volatilities, sigma is another term for implied volatility. When does the market think earnings week is? Yeah, it's the May 8 contract, correct. All right. And so I can gather information from looking at weekly implied volatilities on when the market thinks stuff is. And I can also find edges. There's been times where I've looked at dates and stuff and the market has been pricing a contract like May 8 to have the earnings cycle. And I look and I go, based on the calendar, I think the earnings might be on the Friday before May 8th or the Thursday before May 8th. They might be April 30th. And this contract is underpriced. It happens a lot. You can strategically look and see, well, when does the market think earnings are going to be? And when do I think earnings will be? All right, so now, one thing I use, this isn't today, but we saw, this was a trade that I had set up. So on this day, we see Tesla have a huge rally. The stock has moved up and down, and I might want to fade the move. I love using calendars and weeklies. I can use strategic weekly calendars to place a bearish trade while reducing my risk associated with the bear position. This may be the one time where I'm willing to kind of take a little less decay. So I buy an announcement weekly put slightly out of the money. So I buy that May 1. I sell a near-term put that is just out of the money as well. Thus, I'm harnessing greater weekly decay. I'm strategically buying a firm weekly implied volatility, and I'm getting short. And I end up with a cheap put that I can turn into new calendar or diagonal or just hang on to. So this was my trade. I wanted to own the Tesla May 202s, paid $630, and then I sold that April 10 weekly at 70 and ended up with that put. And this is what that calendar looked like. All right, and if I look at some different trades, let's see, who's got an announcement coming up that might be of interest? See, Valiant just had earnings. We can actually set one of these up. Does anybody have an event stock that they want a stock that's recently moved that maybe has an event coming up? We have JWN earnings coming up. Those are later in the week. Alta. I love Alta. All right, here's one. So Alta has earnings. You can actually see when Alta has earnings. I mean, look at this. For starters, look at that volatility differential. You want to know why Alta is going to keep going up? I call it my wife is named Lauren, and she runs a blog called Big Blonde Hair. All right. And I was looking at Alta, I was talking about it in our chat room, and Lauren looks at me and goes, you know, I can't walk in there without spending $100. And my first response is, well, then stop going there. And my second response was, that stock's going to keep going higher. So now for starters, if I was going to trade this, my weekly spread, the weekly trade I would do, I would want to buy these regular August calls. And I had a position on earlier in the week. But the August 262.5 calls for $2.50. And then selling the 267s. This call spread's just too cheap. In my opinion, obviously. I mean, $1.60 for a 5-point vertical, that's 60 cents out of the money. I'll take it. All right, so now, let's look at how I might use weeklies. Now, you can see there's huge volatility on this August 26th strike. And truthfully, this August volatility is too low. But let me just show you how I might set up a trade around an event. Like I said, I think this is going to the moon. Well, why wouldn't I buy the August 26 calls for $8.25 and the 267 calls, let me look at these to make sure I can, are worth about 80 cents. They're about a 15 delta, or about 21 delta. Okay, those have enough teeth that I can sell them. So now, here's the beauty of a trade like this, using weeklies against each other. One, if Alta rallies for the next week, am I happy or sad? This is how when I was learning to trade, my boss would, my trainer would say, he'd be like, so this happens, are you happy or sad? Every question was blah, 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 are you happy or sad? Blah, 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 are you happy or sad? So if you put on this calendar spread and Alta rallies to 267, are you happy or sad? You're happy. All right, now, if Alta sits here, just kind of sits around 262, are you happy or sad? you're actually happy. You're not as happy as a rally, but take a look at the decay here. All right. I'm producing a little bit of weekly decay, so it's not really killing me. All right. Now, if the underlying drops, I'm of course a little sad. All right. So that's the nice thing, is that trading these weeklies off each other, trading these weeklies off each other reduces my cost of owning these calls, these August calls, all right, which have a fake decay because the volatility is going to increase. All right, so when I look at my risk chart, when I look at this 3D risk chart, I want you to look at what happens. I'm going to move my date to, let's say, next Wednesday. Now you can see it says that I've lost some money here, right? But if volatility is up, which it will be, I'm not really losing very much. And if we rally a bit, I do great. So I'm strategically setting these things up. Now what I like even better is after you get a move, then using calendars. So other uses, I use weeklies for butterflies all the time. I use it for wheel trades, where I'm selling put, taking delivery, then selling covered calls. I use them for calendars and double calendars. I use them for directional calendars, which I just showed you. And they're not, I'll be honest, they're not that great for iron condors. Why? Decay, decay, decay. The edge of them stinks. So in summary, decay is more nuanced. Weeklies can be good for credit and debit spreads if you do them right. Weekly value is in strategic trading, and weeklies are great to finance directional opinions. All right, so here is what we're doing. Saturday, August 30th. Right, is that August 30th or August 27th? I think it's 27th. Anyway, yeah, Saturday, August 27th. I apologize. All right. We're going to be doing a weekly, this should say, trading weekly options. I apologize. We're going to do a Saturday class from about 9:30 to 1 o'clock Eastern Time. We're going to cover weeklies in depth. So 2 hour 15 to hour and a half minute to 90-minute presentations on weeklies covering a lot of stuff. Truly getting into weekly decay, integrating implied volatility into weekly trading. We're going to talk about directional trading, butterflies, and calendar spread trading in detail, and we're going to talk more on risk management. If you go to our store, so we did this class a year ago, and if you go to trading weekly options, it's $250 in the store. All right. Now you can buy it there for $250 and it's a good class, or you can attend live on the 27th and get a recording for $147 and use code 25_off, OFF, off in all capitals, and we'll take an extra $25 off All right. And so, and that'll be good until next Monday. 25_off. And you go to optionpit.com/weeklies. And you're saying, Mark, you misspelled weeklies. And actually, the weeklies are trademarked by the CBOE under the spelling WEEKLYS. So I'm actually spelling weeklies options correctly. So I'll also have a copy of this webinar there, along with the fact that we're going to send a copy to you. So there you have it, folks. Any questions? I know that was a lot of material.
Nice job, Mark. You did, yeah, you covered a lot of good stuff. I was kind of over here taking notes on my end. Definitely had some good takeaways about the differences between weekly at the monies versus monthly at the monies. That was a big takeaway for me. It was cool that you kind of went through a few different examples of it.
Mm-hmm. Yeah.
That definitely helped.
Good. Well, I think that the live examples and having a true understanding of kind of in today is really the key. So any other questions? Otherwise, we'll let everybody go.
Yeah, nice job.
All right.
Any questions that come up, you could take a minute to answer them, but just everybody to know, like you said, if you just go and buy the training of this, it was like $250. So even if you can't make it live on Saturday, it's still a better deal to sign up for it. On this one, you actually save $100 because he sends you the replay of it.
Yeah. Yeah, I mean it's half off and you get to attend live. That's a pretty good deal.
Yeah, I definitely agree.
Yes, we do. Do we cover how to select option candidates? Always. I mean, you heard me talking about right now. I mean, hint. Tomorrow, one of the first things I'm going to be doing when we open is buying that Alta call spread, and that was just that all just happened in passing. All right. Well, we'll let everybody go. Micah, thanks a lot. I will see you on Thursday, assuming my wife doesn't go into labor. And
yeah, congrats on that, by the way. Just
I want to thank everybody for coming, and we'll put the recording out. All right, guys. I hope everybody has a great day. Talk to you soon.
Thanks, Mark. Bye.
Thanks, Micah.